Right now, as you're watching this, there are traders sitting at desks, some of them managing more money than most countries print in a year, and they are receiving margin calls they cannot meet. Not because they were wrong about silver, because the rules changed while they were winning. Tha pasted. If I give you my script, you can increase its retention level by finding and correcting its shortcomings. Please write it without heading timestamps and other subheadings, etc. Just give me a pure script for voiceover. 9:55 p.m. Analyzed script weaknesses and strategized retention-focused voiceover optimization. Analyzed script weaknesses and strategized retention-focused voiceover optimization. Here is the script rewritten for maximum retention, tightened, resequenced where the pacing sagged, and rebuilt with stronger open loops, shorter punches, and cleaner transitions throughout. Right now, as you're watching this, there are traders sitting at desks, some of them managing more money than most countries print in a year, and they are receiving margin calls they cannot meet. Not because they were wrong about silver, because the rules changed while they were winning. That one sentence is the entire story. And if you don't understand what it means by the end of this video, you are dangerously exposed. Whether you own silver, trade commodities, or simply live in an economy held together by $251 trillion in debt. Stay with me. Because halfway through this video, I'm going to show you something that happened in 1980 that almost nobody connects to what's happening in silver right now. And when you see the connection, everything about this moment is going to snap into focus. Let's start with what you actually saw. Silver printed in the mid-80s. Futures were cited around $86 per ounce, and almost every financial media outlet called it a surprise, a shock, a meme trade gone parabolic. They said it like lightning hit a building nobody was watching. It didn't come out of nowhere. It detonated because the system spent months, methodically, mechanically, building a pressure chamber. And then physics did what physics always does when pressure has nowhere left to go. Here is what actually happened beneath the price chart. The CME, the exchange that sets the rules for how futures contracts are collateralized, changed its methodology for precious metals margins. They shifted to a percentage of contract value framework. And then they raised requirements multiple times in rapid succession. I know that sounds technical. I'm going to make it simple enough that you will never misread a silver rally again. Margin is not a fee. It is not a transaction cost. Margin is a cash deposit the clearing system demands from you to prove you can survive a move against your position. Think of it as a security deposit on a leveraged bet. The exchange holds it, and if you can't post it fast enough, they don't send a warning letter. They liquidate your position at whatever price the market gives them. Here is what changed, and why it's lethal in a rising market. Under the old fixed dollar margin system, if silver surged, your required collateral stayed roughly the same. Your profits grew, your margin burden didn't. You were winning faster than the system could demand anything from you. Under the new percentage of contract value system, the higher silver climbs, the more cash the exchange automatically demands, because the notional value of your contract just got bigger. Your position is winning. The system doesn't care. It wants more collateral. Right now. Today, before the close. Picture this. Silver is ripping higher, your account is showing gains you've never seen, and simultaneously your broker is calling to say you need to wire more cash in the next few hours, or they will begin liquidating your positions. If you have the cash, you survive. If you don't, even if you're completely right about where silver is going, you become a forced seller into a rising market. And when enough forced sellers hit simultaneously, what started as a rally can turn into a collapse in hours. That is not a prediction, that is the plumbing. And that plumbing has flooded this exact house before, 3 times in living memory, and each time the majority of participants were stunned, not because the signal wasn't there, because they were watching price and ignoring plumbing. I want to take you through each one, not as a history lesson, as a blueprint. Because this is not a coincidence. It is the same machine, running the same sequence, wearing different clothes across different eras. Once you can see the machine, you stop being surprised by what it produces. In the late 1920s, the world's financial architecture revolved around gold. Gold was the settlement layer, the asset every bank, every government, every contract ultimately traced back to as its anchor. People understood money the way people understand gravity. You don't need to understand the mechanism. You just know things fall. Then the credit system found a trick. If you could borrow against rising assets, and those assets kept rising, borrowing looked indistinguishable from earning. Banks extended credit. Brokers offered margin on stocks. Regular people, emboldened by a decade of rising prices, took on leverage, because rising prices made leverage feel safe. That is the critical psychological signature of every bubble in history. Rising prices get mistaken for falling risk, and here is where most people think the story is about the crash of 1929. It isn't. The crash was the symptom. The collateral chain was the disease. When confidence cracked, brokers didn't gently ask for their money back. They issued margin calls, and because almost everyone had borrowed to buy, almost everyone had to sell to repay. Forced selling drove prices lower. Lower prices triggered more margin calls. More margin calls triggered more forced selling. The spiral didn't require panic or irrationality. It just required math and contracts. By the early 1930s, the debt structure was simply impossible to service in the real world. The political response wasn't to let the market slowly heal. The response was to change the rules of money itself, culminating in 1933 and 1934, when the United States repriced the dollar's relationship to gold by government decree. The lesson is this: when the credit structure cracks, the system heals itself by repricing the relationship between paper claims and real things. It is not optional. It is structural. Hold that thought. Because the second case study is where most people lose the thread. After World War II, the world built a new monetary architecture. The US dollar sat at the center, explicitly backed by a promise. Foreign governments could convert their dollar reserves into gold at a fixed rate. The dollar wasn't just a currency. It was a claim on a real asset at a guaranteed price. The system worked as long as the US ran roughly balanced books, and the gold stock kept pace with global dollar obligations. It did not keep pace. The US ran deficits. It funded military operations and domestic expansion simultaneously. Dollars flooded the world. But the gold backing those dollars did not multiply the same way. A gap opened between promises and reality, slowly at first, then faster. By 1971, the gap was undeniable. Nixon announced the suspension of gold convertibility on television in front of the world. The dollar's anchor was cut. The promise was broken publicly. What followed was a decade of inflation, distrust in paper money, and a flight into hard assets, real estate, commodities, and above all, gold and silver. Money poured in. Leverage poured in behind it. And between 1979 and early 1980, silver went nearly vertical, running to almost $50 per ounce from single digits just a few years earlier. Now here is the part the history books skim past. Pay close attention. The exchange didn't just watch, it acted. Margin requirements were raised dramatically and rapidly. And then the exchanges went further. They imposed rules that allowed traders to close existing positions but restricted them from opening new ones. The market's ability to buy was surgically removed. The ability to sell remained fully intact. When leverage meets a one-way door, the outcome is not a debate. It is a collapse. On what became known as Silver Thursday in March 1980, the price broke violently, not because silver's fundamentals had changed overnight, not because industrial demand dried up, but because the rule changes in collateral and trading access made the leveraged long side impossible to sustain. That moment revealed something most financial education never teaches. Markets are not only moved by supply and demand. They are moved by whoever controls the rules of collateral and access. And those rules can change while you're holding a winning position. Now forward in time. The third case study happened within living memory of people who are active in markets right now, and many of them still don't fully understand what hit them. After 2008, the global response to a near collapse of the financial system was explicit and unprecedented. Central banks cut rates towards zero. They bought assets. They injected liquidity. The message was, paper is safe, paper is backed, paper will be supported. What that message actually did, over years, was push investors out the risk curve and expand leverage across every asset class. Silver ran hard into 2011, approaching $50 per ounce again, 30 years after Silver Thursday, almost the same price, almost the same vertical run. And then the CME raised margin requirements, multiple times, in rapid succession. Each raise forced participants to post more collateral. Those who couldn't were liquidated, and silver fell sharply. Not because the case for silver had collapsed, not because the monetary concerns had evaporated, but because the leveraged layer couldn't survive the new collateral reality. 3 times, the same machine, the same sequence. And every single time, the majority of market participants were shocked because they were watching price and ignoring plumbing. Don't be in that majority, because the machine is running again. The foundation of the current system is sovereign debt treated as baseline collateral. Government bonds, instruments created by governments that have every political incentive to spend beyond their means, are the bedrock collateral asset of the global financial order. That collateral chain requires one thing above all else to hold: confidence that debt can be serviced without destroying the currency that services it. Global debt is currently above 235% of world GDP. The IMF's own figures put the total somewhere around $251 trillion in a world running that amount of accumulated promise. Promise built on promise, derivative stacked on derivative. Any change in collateral rules doesn't just affect one market. It vibrates through everything. That is not a normal environment. That is an over-leveraged civilization operating with almost no margin for error. And right now, with silver printing in the mid-80s and the CME having shifted to percentage-based margin methodology and raised requirements multiple times in this volatility regime, the collateral machine is doing exactly what it always does at this phase. It tightens the rules to protect itself from default cascades. And in doing so, it creates the very forced selling that amplifies volatility, which then justifies tightening again. Higher price, higher margin requirement, more collateral demanded, more forced liquidations, more volatility, more justification for another margin hike. It is a loop. And if you are carrying leverage you cannot fund under extreme stress, you are inside that loop right now, whether you know it or not. This is the part where I need to be direct with you, because financial media will not say this clearly. The forced repricing that follows this kind of stress is almost never a clean, single-direction move. People expect either silver goes to $200 with no interruptions, or silver crashes and everything resets. Neither of those is how systemic repricing has ever actually worked. What happens is more violent and more confusing. First comes the purge, sudden air pockets, flash breaks, liquidation cascades that happen so fast you cannot react. Winning positions get closed not because the thesis is wrong, but because they became too capital-intensive under the new rules. Strong trends experience the ugliest breaks exactly at the moments when everything looks most certain. This is the defining feature of systemic stress. It punishes the most crowded correct positions first. Then, after the leveraged layer has been cleaned out, comes the reality repricing. The market is left with the underlying truth it has been pricing around: currency purchasing power, debt sustainability, and the scarcity of real assets that don't carry somebody else's promise. That reality doesn't disappear when leverage is purged. If anything, it becomes more visible. Understanding which phase you're in is the difference between surviving the machine and being used as its fuel. So here is what the systemic thinker does differently. And I mean this not as motivational language, but as an operational framework. They treat margin rules as primary information, not background noise. The exchange's collateral policy right now is not a footnote. It is the dominant force shaping silver's price behavior. If you cannot explain the current margin methodology and what a further hike would do to your position, you are navigating without instruments. They size their exposure as if margins could rise again and volatility could double from here. During systemic stress, both of those things are normal. They are not tail risks. They are base cases. They understand the fundamental difference between owning an asset and renting leveraged exposure to an asset. Owning is slow. It doesn't call you at 3 p.m. demanding more cash. It doesn't liquidate you during a flash crash and leave you watching the recovery from the sidelines. Renting through leverage is fast. And in the phase we're entering, fast gets killed first. They keep real liquidity, not credit lines that can disappear when a bank's risk department gets nervous. Actual cash they can deploy in minutes, because in a margin event, the window between a call and a forced liquidation can be hours, not days. And they never mistake rising prices for falling risk. That is the oldest error in financial history. It has produced every bubble ever recorded, and it is being repeated right now by people who are watching silver move and reading it as confirmation rather than as a warning signal dressed in the clothes of a compliment. There are 3 beliefs that appear consistently right before a systemic repricing forces people to reckon with reality. You will hear all 3 expressed as confident certainty in comment sections, on financial podcasts, and in newsletters over the coming weeks. I want to name them plainly. The first is that this time is structurally different, because of technology, electrification demand, or some specific fundamental that makes the current move exempt from historical patterns. Technology doesn't erase the mathematics of debt compounding and collateral scarcity. If anything, it increases speed and linkage. It makes the forced selling happen faster and across more markets simultaneously. The second is that modern risk management systems prevent the old patterns from playing out. Computers don't remove margin calls, they accelerate them. Algorithmic risk management doesn't reduce volatility at the tails, it concentrates it. The 2011 silver break happened faster than the 1980 break because the systems were more computerized. If this episode breaks, it will happen faster still. The third is the most dangerous. The size of the move proves the thesis. Silver is up, therefore silver was right, the bears are finished, and now it's safe to add exposure. This is the most lethal moment in any vertical move, the point at which price action gets mistaken for permission. Silver is not ripping into the mid-80s because the system is healthy and supply-demand dynamics are finally being priced correctly by a rational market. Silver is reacting the way monetary metals react when the credit system is showing fractures, attracting flows that are partly fundamental, partly monetary fear, and partly leveraged momentum that creates its own feedback loop. And that leveraged momentum is precisely what the collateral mechanism will eventually target. What you are watching right now is not the end of this move. It is the system entering the phase where the move becomes most dangerous, most volatile, and most capable of inflicting maximum damage on the maximum number of participants. Because that is what the machine does at this stage. It creates conditions where both the people who are right and the people who are wrong can be simultaneously destroyed by the same mechanism. The ones who survive are not the ones with the best price target. They are the ones who understood the machine, the collateral architecture, the margin methodology, the sequence of purge before repricing, and structured their positions so they could remain standing when the clearing system comes for everyone else's leverage. Silver is a lie detector for the credit system. It doesn't lie. When the world is drowning in promises, real assets reprice against paper claims. Not smoothly, not gently, and not on a schedule that accommodates your stop losses. They reprice violently, in phases, with enough pain distributed along the way to shake out the people who are most correct, but least prepared for the mechanics of how correctness actually gets expressed in a stressed market. And here is the cruelest irony of systemic stress. The people who understood the fundamental thesis earliest are often the ones who accumulated the most leverage, held it the longest, and subsequently faced the largest margin calls when the purge arrived. Being right about where something is going does not protect you from being wrong about how it gets there. The path matters as much as the destination, and in a collateral-driven market, the path always includes at least one moment that feels like the thesis is breaking, even when the thesis is exactly correct. So the question you need to answer is not whether silver is going higher. The question is whether you are positioned to survive the purge that happens before it does. And the answer to that question has nothing to do with your price target, your fundamental analysis, or the conviction of your thesis. It has everything to do with your capital structure, whether the positions you hold today can withstand a margin hike tomorrow without forcing you out of the trade at exactly the wrong moment. In the next video, I'm going to walk you through the actual architecture of how clearing and margin systems were designed, why exchanges are structurally incentivized to raise margins at exactly the worst moment for market participants, and what the historical timeline between the first margin hike and the forced repricing has looked like across each of the 3 case studies we covered today. The numbers are specific, the sequence is predictable, and knowing it ahead of time changes how you position. Subscribe now and turn on notifications because that video is being published within days. And if silver continues the move it has started, the window between understanding the machine and being consumed by it is going to be very short. If you're watching this with silver already printing in the mid-80s and margin pressure building in the background, do not treat what you just watched as entertainment. Treat it the way you'd treat a pressure gauge reading red in a system you depend on. The pressure is already here. The only question is what you do before the valve gives way.